Hello, everyone, and welcome to Investing with IBD podcast, sponsored by Vantage Point. It's December 8th, 2021, and we have on the show today myself, Justin Ellison, your host, as always. Irusha Paris, our O'Neill Global Advisors portfolio manager, will be joining us in the third segment, but right now, I have the pleasure of talking to Dave Ellison. He's a portfolio manager at Hennessy Funds and has a lot of experience in the industry. We were talking yesterday, and I'm really excited to get some of his insights, especially on the financial sector, which is where his specialty lies. So welcome to the show, Dave.
Thanks, Justin. It's the first time I've been on, so hopefully I'll be, I'll say something intelligent.
Yeah, and if you do, we'll even have you back. How about that?
Yeah, there you go.
Just one intelligent thing. Our standards are low, so it's okay.
Yeah.
Well, let's start with a little bit of your history. You were telling me how you started at Fidelity back in 1982, which, of course, that was the start of this major bull market run that was phenomenal all the way up until 2000, really, with some breaks, of course, in between, like 1987. But you also had the benefit of getting some tutelage from this investor that we know of, Peter Lynch. So maybe talk a little bit about the start and some of the things that you learned from that legend.
Well, I think when I joined Fidelity, the director of research, Dick Haberman, came to me and said, well, we're going to give you the banks, the small banks to follow. There've been a lot of banks converting to public ownership, the mutual conversion, which was a big thing back then. And the reason why he gave me that job or gave me those companies is because I'd been a teller when I was in high school and college over the summer. So I, his view was that I was an expert on banks. So that was the early days of choosing analysts at Fidelity. That was the standard. So I jumped over a low bar before it got a lot higher later on. So you
could have been in the automotive industry just by virtue of having driven a car.
That was something like that, right? Right. Or done alcohol on the thing, actually drinking alcohol. So, but I mean that was. I got there and the company was very small. Nobody really cared about the market. Rates Fed funds were at 17, 18%. The money market funds were yielding 12 or 13%. That's where most of my money was, which was $1,000 at that time. And then you had this big, as you mentioned, this big shift started to happen. I didn't predict it. I didn't expect it. I just went along with it. But it was a interesting time because you went from being sort of unnoticed to suddenly everybody wanted to hear what you had to say because the market was going up, and somehow people were starting. Even back then, they were confusing genius with a bull market, and so we just played. The company just played along with it, and now here we are. So, but I did that for 13, 14 years, and then I started a mutual fund company inside of FBR. Which was a broker dealer in DC. And then we sold that in 2012. And now I'm back to my old Fidelity days of just being an analyst and a portfolio manager. So I've come full circle in my career.
So, one of the things that, of course, a lot of people in this market are looking at, we've had this whole run. And I mean, you had the coronavirus crash. Some people are looking at the run that we've had since the great financial crisis of 2008 and, kind of thinking of that as uninterrupted. I kind of view it myself as, hey, we did have some pauses in there, some corrections through time at least. But then, of course, we had this coronavirus crash. And now, certainly one of the mentalities that's becoming entrenched, it seems, especially based on the action of this last week, is this whole buy on the dips mentality. Sometimes this is something that gets entrenched, and it's something that absolutely works until it doesn't. But is this something that you're seeing yourself? Do you think that it's worth pursuing the buy on the dips strategy, or are there any cautions that you have against it?
Well, I think the bigger question or the bigger observation is that 2008 was kind of the culmination of many years of financial deregulation and financial growth, where the financial sector, mutual funds, bonds, private equity, individual investing, stock trading, was growing much faster than the overall economy. This year the S&P is up, 20-something%. The economy is not up 20%.
Right.
So it's growing faster than the economy by big multiples. And it's been doing that for many years. And so I think that was a period where the financial system got so big, so unregulated, so uncontrolled, and so unknown by the Fed because there were a lot of new products. And I've always found in financial services, the new products are where the problems are.
Yeah.
The traditional mortgage was not a problem. The no-doc liar loan was a problem. And there's a big difference between those two.
Or the way they were packaged,
right?
Which was the new product.
You had that part too, right? Where they were packaging and holding but anyway, there was accounting changes. We went from no mark to market on assets, and a lot of other things. Leverage came in. They could do a lot of things they could do that you sort of heard about after the fact that, well, I can't believe they could do this stuff. And of course, it was already too late.
Yeah.
But what we had then is the Fed came in and said, look, guys, and these to the big banks saying, look, you guys kind of messed it up. You're over your skis. You're all going to fail if we don't come in and really do something big. They did that. And the quid pro quo was that we're going to take you over in a sense. We're going to nationalize you through Dodd-Frank, through the stress tests. So now the big banks are all controlled in a sense by the Fed, what they can do, how much they can leverage, what liquidity they have to have, whether they can buy anybody or sell anybody. And that was the beginning of basically the Fed sort of taking over the financial system in a much, much bigger way. And that started this idea, well, if the Fed's going to be there, then you can buy the dip because they're not going to let the market go down a lot. So this buy the dip thing really, to me, it began when the Fed really started to become a much bigger factor in how financial assets were priced. And so they've taken over a lot of the pricing of financial assets, bonds, stocks, real estate, junk bonds, regular bonds, because they're buying it all, or they're saying, look, if it gets ugly, we'll just buy it. We'll just buy whatever we need to buy to keep the thing going. So if they're going to control those prices, there's no reason not to buy the dip because they won't let it go that far.
So now, of course, in this last month, we've had a lot of the talk of what's going to be happening with the taper. Some of this easier money. I mean, $120 billion a month injected, in the form of buying assets, as you mentioned. Some of that going away. Maybe a little bit more hawkish comments lately from Powell. In addition to the removal of the word transitory when describing inflation. Is that a little bit of this, the fear of taking away the punch bowl, or is this, in your mind, like a temporary fear because they're always going to be so willing to bring the punch bowl back if people complain too much?
Well, I think the punch bowl is now required, not a luxury, and that's just the nature of, how prices are set and how the economy works. If you let things get too high and you can control it, the downside of letting it go down is pretty damaging. But I think sort of what's happened in the bigger picture is that it used to be about the temperature of the water in the bathtub. That determined what the Fed was going to do. They would raise rates, lower rates, depending on the temperature of the water in the bathtub. Now it's the level of the water in the bathtub. So we've gone from hot economy and cold economy to a liquid economy or illiquid economy. And right now there is, because of the pandemic and what the Fed has done because of the pandemic and what the fiscal policy has done, is they've injected so much money into the system that now we have an incredibly liquid economy, an incredibly liquid financial system that has, in a sense, all the money. And they're struggling to inject it into the economy. So if you take the largest, the top four banks, you take, Citigroup, Bank of America, JP Morgan, and Wells Fargo, those are the biggest American banks, and their deposits exceed their loans by $6 trillion. I mean, those numbers are just way off the charts historically.
Right.
So that money is sitting there trying to get injected into the economy, and they're struggling to do that because the economy just either can't handle it or doesn't know what to do with it. And they have, and then you look at most of the big companies, the top 20 or 30 big companies in America by, let's say, market cap,
right,
they've all got tons of money too. So the system is just the bathtub is full.
Mm-hmm.
And it doesn't matter what the temperature of the water when the bathtub is full. You got to be careful, else you're going to spill it on the water, on the floor. And so the question now is if they're going to start reducing liquidity, which I think is, probably you might as well try it, because, going the way we're going now is destabilizing. The other way is destabilizing too, but you might as well try it and see what happens, because you can't just keep flooding them. The system already has too much money.
Right.
And so and that's why you're getting inflation. And so they've got to find a way to tamp that down. So I think whatever they do is ultimately a positive to kind of take some of the water down in the bathtub.
Okay. So this kind of gives, I guess, an overarching theme of some of the things that you're seeing. When we come back, maybe we can get a little bit into how investors can benefit or find some alpha when there's so much liquidity in here. And so we'll get to that right after the break. We'll be right back. Do you feel like you're always late to the best trades? You don't have to kick yourself for those missed opportunities any longer. Today is your day. Vantage Point's artificial intelligence has helped traders of all experience levels with its predictive analysis forecasting. Visit www.freestockcoaching.com and find out how their AI automatically recognizes global market patterns well ahead of the news to help you pick the best trade. Go to www.freestockcoaching.com to join a free live training session today. Vantage Point's patented artificial intelligence can give you a massive edge. Don't hesitate, save your seat now. Trading involves financial risk and is not suitable for all investors. Past results do not guarantee future performance. Welcome back to Investing with IBD podcast, sponsored by Vantage Point. It's Justin Nielsen here, your host, along with Dave Ellison, portfolio manager at Hennessy Funds. And Dave, of course, is an expert in finance since he was a teller back in his college days. That's what started his whole journey here. And we were talking a little bit about these big banks and how much they're sitting on in terms of cash and deposits as opposed to their lending. Now, one of the things that I've been looking at to a degree is the regional banks. How do the regional banks, some of these smaller guys, fit into the picture? Are they in the kind of same boat, or is there something that they're doing a little bit different that could lead to, I guess, a better runway for them in the future for their stocks?
Well, I think that when it comes to, again, you go back historically, years ago, rates were much higher. The yield curve was a little messier. And every bank sort of had a different strategy in terms of manage interest rates, manage credit, manage expenses, manage their consolidation opportunities or merger and acquisition opportunities. And that is all kind of flattened out, meaning that most of the banks have the same yield on assets, give or take. They all roughly have the same cost of funds because everything's been homogenized. There's no regional differences in mortgage rates or deposit rates or costs of doing business. And so these sort of regional banks, I call them sort of piles of assets waiting for, spring to come so that they can grow again. Mm-hmm. And spring is not going to be determined by, the cellular move, of moons and stars. It's going to be determined by what the Fed does and what other sort of people decide to want to do. And that's just a very difficult position to be in. So I'm not a huge fan of the regionals because they just don't have the girth or the profitability to invest in the future. Mm-hmm. And they're stuck in this sort of, they're big enough to not be able to do much except deal with the pricing. So the problem is that they can't price their assets. The price of their assets is set by the Fed and the marketplace. They can't set the price of their costs, which is their money, which is kind of set by the Fed. Imagine if we went to Apple and said, the Federal Reserve is going to set the price of your phones, right? And the Federal Reserve is going to set the price of your cost of that phone. Mm-hmm. I mean, what would the stock do, right? I mean, and so they just don't have a lot of control of their future. And so it becomes a difficult, thing to buy unless you get this wonderful macro environment, mm-hmm. like a steep yield curve, tons of loan demand, no credit costs, a lot of M&A. It's like, okay, well, I guess how many iterations do you need before you miss one, right? So it becomes very difficult. So they're kind of just piles of assets waiting for something that I probably am not going to ever see.
Okay. So now with this homogeny that you're talking about, I guess where do you find alpha then? Where do you get the outperformance? I mean, certainly a lot of the financials looked like they were setting up, but then of course, as the 10-year yield, Treasury yield was going up, there were fears that the 2-year was going up too quickly and flattening the yield curve in that regard. So where do you go to get that alpha? Where do you go to get that outperformance?
Well, I think in the big companies, you have to own the waterfront property. So it's not necessarily, yes, I own Bank of America, I own JP Morgan, but I also own BlackRock and Blackstone and Market Access, and I own Visa and MasterCard. I own, so those other companies is where the alpha is, because that's where they have the ability to grow and take share. And you hope that somebody like a Bank America or JP Morgan or Wells Fargo has the foresight and the ability to see what's going on in the world and be able to act on it because they have the capital to do it. And so I think the other thing the industry struggles with is the fact that they're caught in this vortex of, I have to earn more money every year, right. I have to pay a higher dividend, and I have to buy back a ton of stock. So if they're doing that, and a lot of these companies, the last 4 or 5 years, prior to the pandemic, they were, between buybacks and dividends, they were basically paying out more than they were earning. And so that's okay. But then if you're saying, well, wait a minute, that's not how Amazon got to be up 1,000-fold by buying back stock and paying a big dividend. The future is not paying dividends and doing a buyback. The future is investing in the future. And I think these companies are struggling to make that transition because they're so stuck on the idea that they need to buy back stock and pay a big dividend. And I think it's hurting the industry's ability to, in a sense, compete with these new tech companies that are entering their business.
Yeah, so let's get into that a little bit. So, what kind of technology do you see as being the driving force? Of course, fintech, crypto. These buzzwords are on a lot of people's minds. What's your take on some of these? Is this where you think you can get more of that outperformance, or is it a wait and see right now to see who becomes the dominant force there?
Well, I think it's okay. I think it's okay to wait and see, but I think because I just think that there's enough uncertainty about how it's going to play out. And I think you have sort of a three-way race here, or a three-way game that people are playing. And one is the sort of this crypto, DeFi, blockchain crowd that, that is sort of this idea that they're going to tear down the existing structure and we're going to move in, the dollar's going to collapse, the system's going to break, and we're going to own this blockchain crypto stuff and have all the money. And the second group is sort of the embedded technologies that are there, that are, let's say the Visa and MasterCard are the ones that American Express would come to mind, where they have the embedded infrastructure to do paperless transactions and so on and so forth. And that's been obviously a huge winner for many decades. And then the last group is what the central banks are going to do, and how are they going to either become part of those two other groups, and they already are part of the Visa MasterCard group, because they but are they going to sort of embrace this blockchain, DeFi, crypto thing, or are they going to create their own universe that that's going to compete with it or something? So I think you're in this weird thing where does it really matter to me? I get a paycheck, the money goes into my account. I use my Visa card. I write checks for other things. These things don't impact me. These are more things that are going to impact the company. And the idea that you go to the coffee shop and you put your card into a Square thing versus an Affirm thing versus a Toast thing versus a Visa, it doesn't matter. All these things are kind of the same. So to some degree, the homogenization of the fintech is already happening. It used to be, Visa, MasterCard, American Express, then PayPal and Square came along, and they were kind of the new guys. And those stocks have done great, over the last 4 or 5 years. But now there's like 30 of these fintech companies.
Yeah.
And they're all trying to, get into your wallet and all this crazy stuff, whatever.
Or provide the loans. You have like the Affirm, the Upstarts, that are trying to put the loan industry on its head, right?
Right, but that's basically the pay. The buy now, pay later is. I saw an ad where they, something was like $200, and they said, you get $19 a month through Affirm. You could sit there and go. So you're going to be buying, TVs on time. You're going to be buying, $100 items, a new coffee pot for on time at Affirm or something. So these things are just, we've gone a long time now without a real credit test in the system. And credit usually is the big opportunity for me in terms of picking the stocks that are going to weather that credit event. And unfortunately, the pandemic hit and the Fed took away the credit game because they just flooded the system with money and credit wasn't a problem, even though the banks were all worried about it. So I think at some point, we're going to have a credit event. It may not happen in my lifetime because the Fed maybe won't allow it, but so we'll see. But, crypto, to me, I look at Bitcoin as sort of the, it depends where you're looking. It's the disco ball at the dance. Everybody's in a circle dancing and everybody looks up at the ball and they see something different in that moment. Mm-hmm. So, people view it as a store of value. It's better than gold. They view it as an inflation hedge. They view it as an alternative currency to everything. People view it, well, it's going to go up, so I'm going to buy it. So it means a lot of things to a lot of people. And that's creating the excitement, because if you think it's a store of value and it's better than gold, and I think it's going to be the next currency of the future, those are two different things.
Right. Yeah.
And yet you're buying it and I'm buying it. Yeah. Right. So if everybody's buying it for their reason, it probably is going to go up, and which affirms your belief, right? There's nothing like something going up to affirm your belief that you're right.
Right.
So that's happening in the system now. Everybody thinks they're right. That, the reason why they bought it is why it went up. Therefore, you've got 20 reasons why it's gone up. Mm-hmm.
So, maybe we can kind of end here with, the fact that you're a portfolio manager and you're actually running two different funds. You're running a large cap fund for Hennessy and also a small cap fund. Maybe you can talk a little bit about the portfolio construction that you're espousing, because again, you're kind of looking at some of these big banks, the entrenched in one way, but then you're also looking at are you looking at some of this disruptive technology in the small cap space, and especially given what happened with the Russell 2000 in the last few weeks, and how a lot of the $1 trillion mega cap are kind of driving the S&P 500, the NASDAQ higher. How do you kind of put on those two different hats of playing both the large cap and small cap, and what's your overall strategy for both of those?
Well, I think the large cap strategy has changed pretty dramatically in the last 4 or 5 years. The fund used to be primarily banks, few insurance companies, maybe Visa and MasterCard. And that's changed. I mean, I've sort of, my view is that you've got to own the waterfront properties to compete. And that means, owning the biggest banks, owning the fintechs that are established, putting in a few other companies that have waterfront positions, like Moody's, for example, I've owned for a long time. I mentioned market access.
Right.
You've got names like SoFi, which are, they're not waterfront property, but they could move in that direction. So, and that portfolio has probably gone from, 80 to 90% banks to 50%, maybe 40% banks, traditional banks you and I think of, and all the others are these other names that I've been throwing out there. The small cap fund, the problem when you get smaller, there's really no fintech, and everything gets closer and closer to It's a Wonderful Life. And so, and there was a lot of companies. There's not that many waterfront properties in financial services. So, I've got 30 names in the portfolio. There are not many more than that in terms of, we talk about waterfront. There's a lot of Me Too's.
Yeah.
And, Apple's been waterfront property. It's been the thing to own in tech. So it's like, okay, I see the pattern. Let's stay with it. Small cap, there's I think we probably look at 4 or, maybe 500 companies every quarter, because there's that many that are public in that small cap space, which is we define as 3 billion or less in market cap.
Mm-hmm.
And there, the smaller you get, the more important managements are.
Okay.
So that makes it sort of more valuable to have a PM as opposed to just an index guy,
mm-hmm.
right? Because I can hopefully ferret out the better managements. But management matters. You want to own the buyers and not the sellers, because consolidation is a big part of the industry.
Okay, so on the merger and acquisition side.
Right. If you can go from, a $1 billion bank to a $50 billion bank and do it accretively,
right,
that's going to make money for me.
Mm-hmm.
And then you've got, self-help, where companies get into trouble, they change managements, they make some bad loans for a couple of years, they bring a new management team in, they clean it up. The stock is, obviously very cheap because of that. And then it rises, and that happens a lot of the time, meaning that there's always self-help going on. Mm-hmm. And then the last really big part is valuation. You got to be disciplined on valuation. And typically you don't want to buy things that are, north of 2 times book or 2.5 times book. And you got to try to buy things that are under book or close to book, with the assumption that they can, improve those returns and trade at some premium above that. So there's just a lot more PMing going on there, mm-hmm. Because you have so many names.
Right. Now, you know what? I know I said I was going to wrap it up there, but you brought up the topic of valuation, and again, I guess I go back to your analogy of the bathtub. When the water level is up so much, and a lot of these companies, just broadly have these high valuations. Are you ever afraid of, okay, if I'm going for those that are, I guess, reasonably priced, I'm missing out on the ones that have the most growth potential? How do you kind of, I guess, manage that disparity there?
With humility, because it doesn't always work. I think that, the concern when you have a fast growing financial company is that they're typically growing the portfolio, they're growing the loan book, right? Mm-hmm. And that eventually, or usually historically, creates problems, because then when credit hits, they're the most exposed, because they've made the most loans at the top, mm-hmm. right? And so you don't know when that happens. Of course, everybody thinks they know, but we don't know that.
It's easy in hindsight,
right? But I think the struggle now is, as I say to people, one of the big problems with the stock market is the valuation. Mm-hmm. I think, to me, it's almost the biggest problem, because if you look at the top 50 banks, the top 50, companies in America by market cap, there's no problems. The companies are making money, they're hiring people, maybe they're firing people, they got plenty of cash. It's the valuation that people have struggled with. Mm-hmm. Which is why you have these knee-jerk downs, because, oh God, it's too expensive to sell it. And then of course it comes right back and people get upset and so forth. So I think valuation is important, but and that's why the nice thing about the small cap fund is the sample size is so large, you can always find cheap stocks, right? Mm-hmm. I mean, it's always relative. There's always the real cheap ones and then the ones that are really expensive. So it's a battle. And I think when the problem we have now is, as I say, when you're investing in financials, you make your money going from ugly to okay to good to great fundamental. Mm-hmm. And we don't really have that cycle. The Fed has kind of taken away that economic cycle. For example, when the pandemic hit, I thought, okay, this is going to be good. We're going to have a credit cycle.
Yeah.
I'm going to presumably own the better companies that are going to come through it. And so this fundamental ugly to okay to good to great is going to play out, and I'm going to outperform.
Right.
And they didn't let it happen.
Yeah.
It happened.
Ugly doesn't exist anymore.
It doesn't. So you don't have that cycle to play. Hmm. And so now it's like, okay, the fundamental, nobody has any non-performers. Everybody's margins are about the same. Everybody's trying to grow loans. So what's the reason to own them? Except maybe there's going to be some spectacular yield curve benefit, some spectacular loan growth. And so you're stuck in this thing where the PMing part becomes frustrating, because there are very few self-help. There just aren't as many as there used to be, because nobody's screwing up.
Yeah.
because the Fed won't let them, right? They just won't allow it to happen. So it's more of a struggle than it used to be. And that creates the valuation problem, because if they're all doing well, they're just not going to get that cheap.
Yeah. Well,
so it's a battle.
Yeah. Well, Dave, I really appreciate you coming on the show. Again, we don't often get into these deep dives on some of the macroeconomic factors. So you bringing your insight to the show is something that we really appreciate. So thanks for coming on.
You're welcome.
Okay. And when we come back, Irusha and I are going to talk about the market and a few stocks that are on our radar as the market rally is showing more signs of strength. We'll be right back. Do you want to conquer market volatility? We can help you protect your hard-earned capital. Visit www.freestockcoaching.com and find out how Vantage Point's AI technology can forecast stock market trends up to 72 hours in advance with incredible accuracy. Vantage Point's patented technology analyzes huge quantities of global data in seconds, so you can finally stop guessing what's going to happen next. Check out www.freestockcoaching.com and experience Vantage Point for free. Learn how successful traders generate their wealth. Trading involves financial risk and is not suitable for all investors. Past results do not guarantee future performance. Welcome back to the Investing with IBD podcast, sponsored by Vantage Point. It's Justin Nielsen, your host, and now joining me, O'Neill Global Advisors Portfolio Manager, Irusha Paris, my partner in crime here every week. Although, yeah, you missed the first two segments, but hey, you know what? Sometimes you're a busy man. You've got a lot of things you're doing. So let's get right into it, Irusha. Kind of a busy week in the market. I mean, we had what looked like a massive amount of destruction in a lot of the leading stocks, and then here we are. It's a snapback. So let's talk a little bit about how people should be positioning themselves. How bearish should they be, or is it, hey, problem solved? Buy on the dip is still in play, and we're back on. What do you think?
Yeah, well, I think the big thing is to keep an open mind and go slowly. What happened last week, and you can even see just by looking at the volume, with the way we broke, and it ended up forcing the markets team to put it into a correction, that was justified. Distribution days were starting to collect. The NASDAQ was breaking below the 50-day moving average. And now in the last couple of days, you're getting that snapback rally, dead cat bounce, whatever you want to call it. We were going to have some kind of rally because we had sold off so much. Now, after that, we'll probably get closer to the truth of, is this rally going to continue? Or is this kind of just, are they going to sell into the snapback rally? Now, this rally, it's gone up on lower volume, right? It's going up to lower volume right to the area where it started selling off. So you want to be patient, incrementally move in. But I think, since we're in a correction, a lot of times the best thing to do right now is, follow Bill's rules. Wait for the fall today. If we're looking at the NASDAQ, this would be day number 3. If we get a powerful day, up more than 1.25% on volume larger than yesterday, and that's not a really big threshold to hit right now, then that's at least going to give you a little bit more verification that we might have that year-end rally still in place.
Now, does the volume signature here bother you at all? Because, I mean, look at what happened with the follow-through day that we had on October 14th. You just saw this day after day of massive volume. It just seemed like every day was above average significantly for quite a while there as you go up that rally. And then you got the distribution cluster, kind of as you talked about, distribution piling up, a lot of big volume behind the downward movement. And here our rally does seem to lack a little bit of that gusto in terms of volume. Is that a concern for you?
It's a little bit of a concern, but it's not as much as a concern as it would have been before 2008. Like, after 2008, once we got in 2009, the markets kind of shifted, and volume, the markets kind of showed that, hey, it can crawl up on lower volume. And that personally threw me off back in 2009 because I was so used to looking at price and volume to confirm the price moves, both on stocks and indexes. But that kind of changed. So it's not going to bother me as much. In the end, it's going to be the individual stocks that are going to tell me when to get in and how much to move in also. So if individual stocks are starting to act well, and there is a whole subset, and we'll go over some of these stocks, that it's not the technology stocks, not a lot of the growth related stock, the higher valuation stocks. It's a lot of this reopen plays, the real economy type of stocks. There are a number of stocks that are working really well, and they're kind of ignored what's going on with the NASDAQ. So yeah, to answer your question in a very long-winded way, it doesn't bother me as much. This is just one data point that you want to look at in the overall scheme.
Yeah. Well, and to your point, I mean, with the individual stocks, here again, I feel like, look, I was getting really bearish at the end of September, as we broke below the 50-day moving average line there. The beginning of October just looked like, hey, we can potentially go down more. This could be it. But then, even before we had that follow through day on October 14th, we were seeing a lot of setups. And I feel like the same thing was happening this time around, to the point where David Ryan actually jumped on in the middle of IBD Live to just say, hey, hold on, you guys sound really bearish, but there are these setups. So let's not forget about that. And again, as you said, it was in a lot of areas, maybe some sector rotation, but it was in some of these areas that were a little bit out of favor before, and so, yeah, we saw the Dow Jones Industrial Average. If you pull that up, you can see that it actually bottomed a little bit earlier. And so yesterday could have been a potential follow-through day on the Dow Jones Industrial Average. It was just missing that volume component, because we still do want to see heavier volume on the NYSE volume than the day before. But yeah, there certainly does seem to be some rotation, but I don't know, the last couple of days, a lot of the action seems like it's come from some of your older names snapping back too. I mean, the Teslas, the Nvidias, even Google was, Alphabet was having a nice, break above a downtrend. So are we going back to some of the big cap techs, holding us afloat to a degree?
It seems like that, with the way they rebounded. Now they had that snapback. Maybe they need to pull in, and then once again, kind of like the markets, you will have to see if they're going to truly hold here. But I think for a lot of the stocks in the Dow and the S&P 500, that's where more of the action is going to be taking place. And honestly, it's almost par for the course for the 2021, right? We've had this rotation over and over again. And this really isn't that much different than the other times where we were surprised at how hard tech got hit, and we're like, oh, it's probably a correction. But then a whole other area, and the S&P started outperforming too, right? So it just seems like we're still in that type of environment, but the market will trend long enough that it makes us forget. and once again, we'll go through that kind of just our normal reasoning that our growth stocks are getting hit. It must be a correction. Instead, kind of like what David Ryan said, and hopping on IBD Live, hey, keep an open mind here. All those stocks especially all those stocks or those areas that he was highlighting back in February of this year, coming up, like a lot of the reopen or the fertilizers and things like that. Maybe that's the area to go back to, because they're building bases again. A number of them are emerging on a big basis, and maybe the tech stocks, they might need to take a couple of months off and build those bases again.
Yeah. So let's take a look at some of these stocks, and maybe we just start with O'Reilly. ORLY is the ticker symbol on this one. This is, again, it's not alone. O'Reilly, it's got a lot of group mates that are also been participating in this rally here. It's, you've got AAP, you've got AutoZone, AZO, and so there's it's not alone, but this is one that just recently broke above a little flat base here, and here again, the move really started early. While the indexes were still pulling back, O'Reilly was showing elements of strength early on.
Yeah, as a number of the stocks I was in, more tech related, were getting hit, I noticed O'Reilly, starting to move up around here, and I was like, maybe this is these are some of the stocks I should move into. They were showing that relative strength, they were showing that divergence versus a number of the growth stocks. And so this is a pretty decent breakout. It isn't great. It wouldn't be a surprise to see this pull back, maybe even back to that 660 level. and then kind of test everyone, shake people out.
Yeah, and I especially with the relative strength, when you have kind of a sector rotation and something that looks like it's getting its relative strength even better because the market's going down and it's doing well. It's nice when you see that it's on multiple time frames still showing strong relative strength, as opposed to something where it's it's only the most recent action that's got strong relative strength, or vice versa. So
well, and we'll go off on a tangent here, Justin, because this is what we love to do. But but some people were asking on Twitter. It's like, hey, your relative strength is lagging right here. Upstart's come down more than 50%. And the RS ratings are 99. Well, yeah, because it's over 12 months, and over 12 months, it's still outperformed 99% of the stocks in the database. Yeah. But what you can do is look at that 3 month and 6 month, the shorter term time frames. And the 3 month, it's only 3. It's only outperforming 3% of the stocks in the database. So that's a very easy way.
That is not where I want to be.
No, that's exactly. Right. You want to see them all kind of line up together. But so O'Reilly, this was a really easy way just to take a quick look and say the moving averages they're above all the moving averages, and on a relative strength on all the time frames, they're doing well, especially if they're all over 90.
Let's go ahead and take another look at maybe one that is a little bit trickier right now. It looked like it was trying to break out and maybe is having some struggles there, and that's Zim Shipping. We've still been talking a lot about the shippers. This has been one of the groups that is shown a lot of strength, but it's recently fallen back down. It was kind of getting up there for a while. What do you do with something where you've got a breakout in the morning? It was looking strong yesterday, then it kind of faded at the close. It was looking strong in this morning, and then by the close, you've got an outside day closing near the lows. Lots of volume behind it. Is this something to be concerned about, or is it like, hey, you just need to be patient sometimes with these things?
Well, I think it's a little bit of both here. You definitely have to be concerned because it was 9.7 million shares traded today, which is the highest volume traded on this whole chart, right? So it went into it essentially. Let's see, it went up to 6150, almost into all-time highs, and got hit with a bunch of sellers there. Now, it doesn't necessarily mean it's over. It might have a shakeout and might be able to recover from that. So a lot of times in a case of this, especially when volume comes into it and it reverses, and this is really a bearish engulfing, it's an outside, it took out the highs of the previous day and also took out the lows of the previous day. So it engulfs it on higher volume. That's a little bit more troubling sign. So here I'm at least forced, if I don't sell the whole thing, and with a kind of a market like it is right now, where it's still, you have to be more cautious than bullish. When I see something like this is more like, okay, prove it to me again. Either I'm getting out of the whole thing, or I'm definitely lighting up by at least half, and then letting the other half tell me very quickly and keeping a very tight leash on whatever I have remaining.
Yeah. Now, one other thing about some of the shippers is they have these really large dividends. And so sometimes, I know that Star Bulk has one coming up, SBLK, one of the group mates in here. It also has, Zim has one coming up fairly soon. So, with that, and I mean, for Zim, I think it's over 4%, of the price. So that's something where MarketSmith will make an adjustment. We don't want to show, because the exchange is going to make an adjustment in price. It's going to adjust it down if it's, a dividend is getting paid out, especially a large one. You're going to see kind of a gap down. But for MarketSmith, we're going to correct for that, kind of treat it almost like a split, and you're going to see an adjustment to the price. So do you think that large dividend is coming into play here? I mean, normally you think of people wanting a large dividend, but do you think maybe people are, hey, I don't want the dividend, I don't want the cash?
Yeah, that's a good question. I don't know. Yeah, usually you would think that they'd hold on, get the dividend, and then maybe get out of it. Yeah, that's interesting. I'm not sure I heard about the dividend, but I'm not sure. I mean, a lot of times I won't try to think about it too deeply in that. I'll try to keep it simple and just say, okay, what is this price and volume saying here? One thing to note with a Zim, and I've tried this a few times, but this is a stock that you're better off buying on the pullback versus on the breakout. right? Or near its high. Even the last time when it got near 60, got sold out. And when it really got past that 55.50, you could have said that was a couple with handle right there that it broke out of, but it didn't make a lot of progress. But a few days ago, I had that nice upside reversal where it undercut the short-term kind of price trading range right there. And then you had some decent volume coming in, nice upside reversal. That was, in my opinion, the ideal time to try to get into it. And if you bought it around there, you still could hold it a little bit longer because you're not really down on it just yet. You're kind of back to where you were a couple of days ago.
So kind of in a different area, but one of these areas that together has been showing strength. A lot of the home builders. We were noting on IBD Live on Monday how real estate was one of the better performing groups. And you have REITs that are actually performing fairly well. So let's take a look at Toll Brothers. Ticker symbol on this is TOL. This is one that broke out a few days ago and is looking like it's continuing to make a move. Now, one of the tricks here, though, was it was having this breakout right before earnings. So you're in a marketing correction. You've got earnings coming up. You see a breakout. Can you even act on something like this?
Yeah, if you're going to act, you would definitely want to go in smaller, especially with all the variables that you mentioned there, Justin. But on, I think it was 12.2, because it was probably around that time, or I think it was 12.1 when a lot of the growth stocks, or the last remaining high valuation growth stocks got hit. We had a number of it was on November 22nd, where tons of kind of cloud stocks, or the Asanas and the Cloudflares, they got crushed. Then eventually they got to the rest of them on December 1st. But so on that day, it was Toll Brothers. I noticed, hey, that's actually up. And it's building a big base. And then the next day on December 2nd, I keep saying 12.2, but December 2nd, that's where your breakout was right there. But it did make it more complicated because you had earnings. So if you were going to try, you can go in smaller, or you could look at the one of the groups that they all kind of travel in a pack together. The housing group, right? The builders, they all travel. So if you saw Toll and noticed, hey, they're reporting earnings in a few days, you could go through and say, are there any other members of the group that are breaking out or recently broke out that already gone past earnings? And there were a few of them.
Yeah.
So
DHI,
DHI, yep.
Was one that's been
exactly. Yep.
Yeah, that one we featured on, I think, stock of the day. It was, it was something that just, again, it was holding up so well. And getting back to your point on the relative strength, you look at either one of these and you see that here again you've got the strong 12-month, but really strong 3-month and 6-month too. So not only is it it's all the time frames, and you would think that with a long base like this that it could potentially lose at least some of that short-term relative strength. But the fact that these still are maintaining that 3-month rate relative strength rating, I think, is pretty impressive for this group.
Yeah, you're absolutely right, Justin. It's not obvious when we're looking at the DR Horton chart here coming out of this double bottom. It's not obvious that they would have a 3-month rating of 3-month relative strength rating of 96. But when you look at the chart and you kind of put everything together, it's like, well, it did go from 82 to 104 during that time.
Yeah.
So I guess it makes a little bit more sense. But yeah, that's why it's nice to have that RS 3-month right up there. I mean, even like Toll. Wow, Toll has an RS rating of 97 during this time, which isn't necessarily obvious because it's coming out of this really big base. But that's why it's good to look at the data points in a little bit different way. The other thing is, especially in a market like this, these bases that have taken some time, and for like a Toll Brothers and a DR Horton, they've taken 4 to 5 months to go sideways. So when they started to emerge out of these bases, those are pretty significant breakouts that they should have a little bit better chance of working, or at least not be as volatile.
Now, I mean, we're talking a lot about the technical side of things, but I mean, there's a fundamental side to these as well. And I mean, with home prices being as high as they've gone, you look at the Case-Shiller index, and you've got these 10-year treasury, which a lot of people are thinking is going to be going up as tapering happens and, potential Fed rate increases down the road. Does it strike you as odd on the fundamental side that the home builders are still strong, or do you like, hey, you know what, I'm not going to question it. I'm just going to go by what the chart is telling me?
I think in the end you have to go by the chart, but yeah, it does make me wonder why. But but maybe I guess it's just more of the housing shortage that has more of the kind of impact, or you have that inflationary kind of thing too. That hey, for a lot of these kind of real assets, I mean, it's ridiculous how much home prices have gone over the last year, especially in LA. It's just like, where are you going to live? You know, so it's so yeah, it is a little crazy, but in the end, the reason why I really love this system and methodology is you don't have to think about all that stuff. You know, look at the earnings and sales, the margins, some other data points, the proprietary ratings, and then look at the charts and see if they're behaving well, see if they're behaving healthy and being accumulated.
Yeah, I certainly, there's a number of times where the chart is saying one thing and I don't know the why, but sometimes the why comes out later, and you know, it's obvious then, but it's never obvious when you're in the moment, right? So, okay, that'll do it for us this week. Next week's show, we're going to have Jim Ropel. We're going to welcome him back to the show. He's always an audience favorite, can slim growth investor, you know, going way back, you know, mentored by Bill and when he was a client of William O'Neill and Company. So we always love having him on the show. So it'll be great to see him again. So make sure you tune in for that. And that'll be it for us this week. Thanks a lot for watching. And for this week's notes and charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.